I started as a life insurance agent many years ago. So I think I can safely say I appreciate what you do and talk the talk and walk the walk that you all do. It's really a challenge. Y'all ought to be commended for the work that you do for the citizens of the state of Nevada, and for that I really do thank you. It is a tremendous privilege and an honor to have this office and to serve. It is the greatest job I've ever hated, or the most hateful job I've ever loved. Every day is unique. Every day is a challenge. But I am so thankful to be in Nevada in this office. I think I'm the envy of my colleagues around the country. We office in Carson City, and the view from my window is the foothills of the Sierras, which is spectacular. I try to not moan too much about having to take business trips to Las Vegas once a month or so. We are part of the western zone of the National Association of Insurance Commissioners, and we have annual zone meetings. For example, the Midwestern zone this year is meeting in Madison, Wisconsin on a Monday in October. Last year, we hosted the Western Zone at Incline Village. We've been to Mount Hood. We've been to Whitefish, Montana. And next week, we're all headed to Kona to meet as a zone with our colleagues. And the following year, we're going to Juneau, Alaska. So I don't get a whole lot of sympathy, but it is tremendous to be in Nevada because we are small enough and nimble enough that the commissioner gets an opportunity to attend meetings like this. And I number hundreds of producers, hundreds of agents, hundreds of brokers in this state who I count as friends, who I listen to regularly. We have quarterly meetings of our Life Health Advisory Committee. We have quarterly meetings of our Property Casualty Advisory meeting. We just had a meeting of our Title Advisory Committee earlier this week, and we listen. That's what we do at those meetings. We want to hear what's going on in the street. We want to know what's going on in the marketplace. These are very helpful, but I think it more importantly, it helps us fashion policy as much for you to take those policy and go back to your clients and provide good product, good service for a good price. It was interesting listening to some of the reports and the mention of overregulation, and I appreciate the thought. Hopefully we're not, I would like to say if anything, we're under-regulating. We do not want to put a crimp on business in Nevada. We have had a directive from the governor from the first day that he was in office. We will be business friendly. And we have taken that to great extremes to make sure that consumers get the best value for their buck, but that you all have an opportunity to do what you do without Big Brother all up in your business. Now, having said that, you get out of the line, you go beyond the bumpers, we will get up in your business, and we have in the past. But I'll tell you that it is not near as common occurrence in this state as we see in other states. We are very much interested in making sure that consumers are treated well, treated right, get a product that's priced correctly, and that the service is appropriate, and that the brokers are treated fairly by our office. Now, having said all of that, I've got this fabulous, well thought out, incredibly terrifically written speech that I worked on for the last 30 seconds. but I really do, at these meetings, it's more of a dialogue, and I want to share some things that we're working on, both in the state and nationally, and in some cases internationally. But I also wanted to be able to answer questions and not exceed our time. So in no particular order, here's a handful of things that I want to touch on. Concept of principles-based reserving, which is has to do with the way life insurance policies are priced, and I'll go into some detail with that. A little bit about our bill draft request of the upcoming legislature coming up. That's kind of redundant. Is the upcoming legislature coming up? Well, we'll talk a little bit about that. I am privileged to serve on the Federal Advisory Committee on Insurance at the U.S. Department of Treasury. Was just recently reappointed. We've had our first meeting. We have another meeting coming up in November. I'll talk a little bit about what we're doing there. A little bit about long-term care. I serve as the National Association of Insurance Commissioners, or the NAIC, chair of the task force that is neck deep in long-term care issues. And I know that's part of your product profile that you can talk to your consumers about. And then a little bit about the future. I'm really heartened that the focus on young agents council, or young agents, is prominent here. You know, it is so key. We were talking to somebody the other day that the agents and brokers that are going to be retiring and aging out of the workplace is significant, and there really is nobody to step up. Very, very few new agents, new brokers coming into the business, so we need to do something about that. I had the opportunity yesterday to sit down with the dean of the business college here at the UNLV, who I might add is a former dean of the business college at the Harvard of the West, University of Wyoming. Proud graduate. Go Cowboys. And but we spent a lot of time talking about the future of their business, the future of insurance in the state of Nevada. And he looked at it from a retail perspective. I look at it from a regulatory perspective. And somewhere in the middle, we're going to figure out a way to encourage educational opportunities for individuals coming into this business. So those are the things that I want to touch on. But if you have a question at any time, please jump up, shout out, and I'll do my political best not to answer it. But you'll go away satisfied. Principles-based reserving, very quickly. There has been in the past an equation used to determine if a carrier has adequate reserves. When I say adequate reserves, have enough money in the bank to pay your claims. And it's been it's been very much an equation of 7x times 4b times 3a times something else, and it spits out a number at the end. During the financial crisis of about 5 years ago, there were a number of companies who said, we need some relief because we need to use the capital that we have in reserves, and we need it now. And we think that this equation that we've been using overly restricts the use of capital. So at the NAIC, we put together several work groups and came up with a program. It's called Principles-Based Reserving. And basically what this is right-sizing the amount of reserves that you have based on the risk. If you have riskier investments, you've got to have more capital. If you have real conservative investments, you need less capital. That's a very simple way to look at it, but that's basically how this works. And what this means for you is that when we pass principles-based reserving here in the state and among 42 other states in the country, it will become basically the law of the land, that your prices for those life insurance products will vary, and in most likely, many cases, come down. So you'll have more affordable life insurance. Carriers will be able to better reserve based on the risk. If they really want more risky products, then they have to reserve more, which means their prices are going to go up. So that's what this means in a nutshell for you. This is going to be in our bill draft request for the legislature this year, so look for that. It's highly complicated. It's very technical. You have now exhausted my understanding of this concept, but basically it is right-sizing the reserves that life insurance companies will be requiring. As far as what's going on nationally at the National Association of Insurance Commissioners, or NAIC, we are neck deep working with our colleagues in Europe to make sure that we have a uniform capital standard so that insurance companies doing business in Europe based in the U.S. or European insurance companies doing business in the U.S. Have a uniform standard. It's easier for those of us who regulate to understand what their reserves, what the requirements are, what their risks are. The problem is the U.S. delegation, the NAIC, kind of got in at the 11th hour on this. And we have been working very, very hard with our European colleagues to make them understand that the U.S. system has worked, works very well, that the type of accounting that we use, the type of products that are sold here are well regulated, and that they should emulate and copy the way we do business. We're not necessarily at loggerheads. We're making some slow progress, but it has been taken a great deal of some of my colleagues' time and focus to make sure that we are not unfairly creating barriers for our U.S. insurance companies to do business overseas. Kind of related to that is the work that I've been doing on the Federal Advisory Committee on Insurance. And one of the charges under Dodd-Frank for that is to look at underserved or populations that are not getting serviced or don't have appropriate products. Not necessarily completely in the U.S., but products overseas in some other areas. And oh boy, I just lost that. That train just went out the door. It'll be back in a second. But we have a sense of what those products should look like, and through the Federal Advisory Committee on Insurance, studied these underserved areas, underserved markets, and try to develop products that go there. And we want to make sure that U.S. products are not unfairly or discriminated against in being able to sell in those areas. If they sell in those areas, they're profitable, that means the products that we sell here can be more competitive. Yes? Question is, the statement that said there are some countries in the EU, the European Union, that have eliminated commissions on life insurance. Are we contemplating that? No. I was going to say yes. I was going to see what happened, but I would have had to get out of the way. But no, there is that hasn't even been suggested or even have brought up. So I can't imagine that that would be the case. If there's additional or new methods of marketing, I'm sure will come into the equation. And if there's a direct to the consumer capacity to sell, that may be the case, and it may be brought forward. But I don't anticipate that anytime soon. So, but that's a great question. Hopefully, the consumer protections, the consumer service that you all provide will be highlighted enough to say, well, carriers, you can do what you want, but if you want to be competitive, if you want satisfied customers, you've got to have a face, you've got to have a handshake on the other end of the contract, rather than just simply checking a box, putting your credit card number in, and having them spit out a policy to you. So I would think that that's not going to be the case. So, but great question. In conjunction with our work next week with our Western Zone commissioners. We have also included a Pan-Pacific International Forum. So we'll be attending a joint forum and dialogue with our colleagues from China, Japan, Korea, Malaysia, Australia, and I think one or two other nations. And we'll be sitting around in our meeting room in Hawaii, talking about how we can best continue to serve our customers, how we can best continue to make sure products are available, how they're priced appropriately, how there's an opportunity for U.S. companies to do business there, and talk about barriers or an opportunity for foreign companies to come in onshore and do business here. This truly is becoming an international marketplace, and we have great products here, we have great companies here. We believe we should be able to continue to increase our export potential and get these products in the hands. I mean, Geico, for example, has made great inroads in Asia. Aflac has a significant presence in Japan. We want to make sure that those opportunities continue to be made available for U.S. companies. We did talk a little bit about, excuse me, the Federal Advisory Committee on Insurance, the initials FACI, and you know, as government entities are prone to do, we make that an acronym, but there is no good way to say that. Very few people found the joke, but thank you for those who giggled. I appreciate it. But there's two focus that we want. One was the underserved marketplaces, and the other one is based on international issues. State regulators in the U.S. cannot speak for the U.S. government. That's in the Constitution. It has to be the United States government speaking for commerce internationally. We've never had this before Dodd-Frank created the Federal Insurance Office, which is where FACI is housed. So our job as being members of this committee is to advise the Federal Insurance Office and the director on insurance issues so that the U.S. government can work with foreign entities on the administration and treaties, if you will, for insurance. So we're going to be neck deep with that. The director of the Federal Insurance Office is the former insurance commissioner for the state of Illinois, who's a good friend, and I think we are to the point with the Federal Advisory Committee that we are now working very closely with them. They are listening to us. As an aside to that, we were very privileged to meet with Secretary Liu from Treasury last December when we were all in Washington and had a chance to sit down and talk through many of these issues. They are listening, they're responding, and I think we're making good progress. To kind of bring this all back down to where you're at, it's vitally important that Nevada and other states have a voice in this, that we can share your stories and your experiences, your opportunities with your customers, and get that to bubble up to the federal level, which then goes to the international level. So I think we're making great progress, Larry. That's a great point, and the question is about HSA money not being able to being spent overseas, and how can we do that? That might be I love the term granularity. I think that's such a hot buzzword right now. But I think that's a level of detail that we will probably get to in the next 6 to 12 to 18 months. But that's a great point, and we'll make sure that that is considered, because I think it's very important for our consumers. We talk about, in fact, we were talking yesterday with in another meeting with one of our state legislators. And the fact that one of the things that Las Vegas is actually trying to work on is making this a destination for medical tourism. And we were explaining and going through all of that and how that works. This ties very closely to that discussion that we had yesterday on this issue. So, talk a little bit about long-term care, and then I don't think I mentioned this when I went down the topics I wanted to talk about, and probably by it was Freudian to not do so with the Affordable Care Act, because I am sick and tired of dealing with health insurance on that issue. But long-term care, yes, sir. So those of you who want to have an ACA question, be forewarned, I am taking names. The question is annuities and regulation of annuities in Nevada and surrender charges and so forth. We have it's perfect timing. We have 3 actuaries on staff, and one of them at all times is working on reviewing and analyzing annuity products. And we've found several products over the last 5 years to be unsuitable for sale because they had long surrender charges, or the surrender charges were way above what should be considered reasonable or consumer friendly. And not that we are arbitrary and capricious when we evaluate that. We very specifically look at that and make sure that they comport with our law, and not just make a willy-nilly decision that we just don't like it because the companies spelled their company name wrong. No, we look very, very closely at this. The annuities that are for sale now that have been approved, I have every confidence are completely 100% compliant with Nevada law. There is no move that I'm aware of to change any statute to address the sale of annuities. Nevada is one of those states that has not yet adopted the latest iteration of the suitability regulation that has been developed by the NAIC. We're looking to do that and do it soon. It doesn't go much beyond what the current suitability regulation that we use, but it does make some things much clearer as to what the obligations of the carrier are and what the obligations of the broker are. So look for that, but I wouldn't say that we're going to change in any way, shape, or form grossly the environment in which you operate now. Does that answer your question? You bet. You know, it's always great, and I learn a great deal of these things. That's a terrific point. And understand that the suitability, I want to say checklist, but the list that the consumer fills out saying, I'm interested in liquidity, I'm interested in long-term capital growth, I'm interested in conservative long-term principal accumulation, all comes into play, and should come into play when that consumer makes the choice, when that broker sits down with them and says, which of this suite of products best suits your purpose. Now, from what you're telling me, Mr. Consumer, is that I can narrow this down to 3 of these 15 products. Now, let me explain the differences between these 3. And the broker should say, okay, here's A, here's the difference between A and B, here's the difference between A, B, and C. Tell me which of these benefits, which of these provisions best suits you. That's what we're after in trying to find out what's best served. Now, that what the product might be that best suits a 45-year-old father of 2 might not be the product that would best suit somebody who's 68 and looking to now start, instead of accumulating, have it pay out of that annuity. So I think that those are the things that we've got to make sure that the consumer understands. So, great point. Yep. And I would say that as a broker, as serving your consumer, that it would be prudent for the broker to sit down and make sure that they understand. You know, hey, you've had this for 2 weeks, you get 2 more weeks to make sure this is what you want. And so if you pass the 15th of next month with this is what you're going to get, and this is what you're going to have to stay with. Do you understand that? You know, it's got to be a partnership. Yes, ma'am. When you say prior insurance, I'm not sure. I'm still not tracking you. Okay. Oh, I see what you're saying. That's a good question. I don't have a good answer for you. I do know that there is some dialogue going on to make sure, for example, servicemen who have served overseas are not put at a disadvantage when they relocate home. And they've had, and it has to do not only from overseas, but let's say you're at Camp Lejeune in is it North Carolina, and then you relocate back to Nevada. You want to make sure that they have every opportunity to renew or buy otherwise, even if it's even if they've been deployed overseas for a period of time. So those are the kind of questions that we're still tackling. Good question. Guarantee Association should not. It should not. The Guarantee Association, and I'm trying to remember the last time that we had a major U.S. company life insurer fail, and it's been several years. And there's many reasons for that. I could fill in your entire afternoon if you'd like, but I don't believe this will impact the Guarantee Association or the viability of those companies, because we collectively across the country look at the finances of those insurance companies on a quarterly basis. I know in Nevada, if we have an insurance company that we're worried about their finances, we make them report on a monthly basis. And so I don't believe this will impact the Guarantee Association, because that monitoring is in place regularly, and there's actionable levels that are early warning signs that will say you need to do something else, or we need to do additional regulatory oversight for those carriers. But that's a really good question. There's a question back here. Great. That's a really good question, and that's an area where we could do a whole lot better than we're doing right now. We look at them from purely an insurance point of view and making sure that those contracts meet the insurance standards. Now, FINRA it probably does a little something a little bit different than we do, but in our interaction with FINRA is mostly on actions against producers and not so much on products. Very little interaction between us and the Secretary of State, where in the securities area. They don't bring us too many problems at all, and we've, to my knowledge, never been questioned about the validity of the contracts that we approve. Oh, what product gives us the biggest complaints? You know, besides the health insurance? Number two? You know, we do have a lot of problems. Fewer now than we've had in the past, but we've always had some questions about suitability of annuity sales, and that's although with you know, we adopted the newest regulation this is 3 or 4 years ago, and that has slowed things down. I think also the insurance companies and the large brokerages have done a much better job on compliance and making sure that the sales force, the brokers that are actually toe-to-toe with consumers, understand their obligations. So that it's those types of complaints. We still get a fair number on auto claims and adjudication of those claims. We still have a fair number of those as well. But between those 2 and 2A or 3, those are the ones. Take your pick.
Question for you in regards to what was discussed earlier, the classification of insurance individuals that happen to have a securities license as a financial institution and the subsequent taxation of those profits from it. Are you involved in any of those discussions or talks with anybody? I mean,
no. Next question.
The reason I bring it up, and I think most of us here that are aware of it, and it would say that it's a really bad decision on the Department of Taxation. And it's not that we know that you don't make that decision, but you're in the same halls or at least in the same area, and you carry some clout with it. And we'd love your support on that, at least, or at least a discussion about it.
We have had some very informal conversations with my colleague over at taxation about this, and it's been some time ago. It was interesting that I spoke at the Northern Nevada NAIFA, I want to say about 9 months ago, when they brought this up, and this is just after the notice had been sent out. And so I walk into a nice luncheon crowd like this and say, hey, how you guys doing? Nice to see you. Thank you for having me. They almost in unison all stood up and pointed their fingers and said, what are you doing about this? This is terrible policy. And I said, well, I don't know what you're talking about. But it is a good point. It seems huge overkill at this point. I can understand if you read the letter of the statute that you could connect the dots there. And given the direction of maximizing revenue within state government, I can understand why they would take that tack. It makes no sense to me at all. It makes no sense to me at all. That basically, I had a State Farm agent say, I'm going to have to give up my securities because even though I make, you know, X amount of dollars selling securities, and because of that I can employ one more person, I have to give that up now if this holds, because of this crazy, ludicrous rule. So I have to diminish my level of consumer and customer service in order to, make ends meet. It's crazy. So. Well, that's a really great question. The question is, have we seen any change in the auto industry since Metro stopped going to non-injury accidents? Anecdotally, a little. Can we, empirically? No, not yet. I think it's too recent a change for anything to adjust those rates right now. I am not going to answer that. I love attorneys. But no, if you at first blush, yes, you're absolutely right. It appears to be a real opportunity for the trial bar to get involved with those types of problems. There's a question back there. Oh, that's a great, business license in the city of Las Vegas. I don't know that I can honestly, well, let me back up. There was a bill draft last session, year and a half ago, that said you all would have to get licensed with the Secretary of State as a business. And we went and sat down with the chief deputy and said y'all are already licensed with us. You've gone through our licensing process. Why would you want to make sure that you have to do it again? If they're already paying for us. You all are all paying us for your license. We don't get to keep that money. Goes to the general fund, just like it would if it was the Secretary of State. So why are we doing this twice? And they understood and struck insurance out of that bill. I'm not sure I can talk to the city of Las Vegas's issue other than it's local politics. I don't know there's a way to address that, albeit for the privilege of doing business in Las Vegas. Yeah, I got time for maybe one more. Yes, sir. Long-term care. That's about a 20. As a disclaimer, I worked for at one point Genworth, what is now Genworth, and did government affairs for them. And we were based in Marin County, California, which is really rugged duty, frontier outpost of. We've just passed last month in Louisville changes to the long-term care model, which we're going to be adopting here in the state. But basically, the primary thing that we've addressed is the concept of large rate increases. I don't know if you've got policyholders out there, but we've been getting requests from many companies of 40, 50, 60, 80% rate increases because of these old books of business that were not valuated correctly. They were developed during a period when investment income was double digits. The policies were incredibly generous. There was very little data to substantiate how claims were paid and how claims were adjudicated. And so the benefits really rapidly outstripped the premium income for the carriers. And what we did was we've changed this now so that insurance companies on a prospective basis have to submit information to the regulators annually on how this book of business is progressing, so that we can identify annually if that book of business is starting to head south. There was a mindset that these products were developed so that you would never, ever have a rate increase if you were a consumer, which is fallacy if you are selling a product that has a potential of a 30 or 40-year tail. There's no way, I dare you today, to say, I know what long-term care costs are going to be in 2035 or 2045. It's impossible. But that's what these products were done. And then if this business was starting to go south in that book, they would just create another product and move their new business over there and let this other product wither. And that's what's happened. This change will hopefully alleviate that, and your consumers may get a 1% or 2% adjustment in their premiums annually. But you won't have, hopefully, those 30, 40, 60% rate increases coming in. We got one the other day. There was a 60% request and said that, you know, if we get this, the chances of us coming back for a 30% next year is highly likely. That's how poorly these products were designed in the past. And we're trying to deal with that. We developed a model bulletin last year that states are now using, saying you must notify consumers if you've got these rate increases. You have to give them options on whether or not they want to continue the policy. They can keep their current payment. You can decrease benefits. You can keep your current payment and decrease the inflation protection. You can take and decrease the amount you pay and diminish your benefits. The consumers now have a lot of options, but this is a product that is, I think, vitally important, because as state budgets go, long-term care that is inside of Medicaid is one of the fastest growing budget line items in state government across the country. We cannot afford to have long-term care insurance fail. That's why it's vitally important for my colleagues to understand. I've actually been invited to go to the Midwestern Zone meeting in Madison next month to kind of get this message across to my colleagues and say, you know, it's hard to swallow and check the box and say, I approve this 25% rate increase, knowing what it's going to do to 60 or 75-year-old people when they're on fixed income. I'll tell you, though, the lapse numbers on these policies are infinitesimal. People understand the value of the product they've bought, and they keep them, and they pay that rate increase, which astounds me. Or they take the benefits, reduce them, but they keep those policies. They don't let them lapse. Thank you very much for having me down. It's always a pleasure to come to Las Vegas.